So David Smith, co-manager of Henderson High Income Trust. Henderson High Income has enjoyed a year of very strong performance. What have been the key drivers of that outperformance?
Well, you would have seen we've released our annual results for 2014 recently, and the NAV total return was 7.5%, and that compared against the benchmark return of 3.4% and a FTSE All-Share return of 1.2%. So good outperformance there, and that really has been driven by, I think, investors sorting out high yield, safe yield in the market, given where interest rates are so and bond yields are so low. So that really has driven the outperformance of the likes of utilities. So where we have a holding in National Grid, United Utilities, Severn Trent have all performed strongly. The likes of British American Tobacco as well. I think elsewhere we've got a large holding in Catlin. That was subject to a bid approach at the end of the year, but also holdings in the likes of Reed Elsevier, Pearson that have delivered consistently strong results throughout the year, really.
Henderson High Income uses significant gearing on a permanent basis. How are you currently utilising it within the portfolio?
So gearing has been pretty stable over the last year. It's currently 22% as at the end of February. But it's important to remember that gearing is the majority of that gearing is structural gearing. So what do I mean by that? It's when we can borrow cheap debt from the bank at say 1.5% and invest that into a portfolio of relatively stable bond assets, currently yielding about 6%. That is obviously a very good way of enhancing the income of the portfolio. Once you strip out that element of structural gearing, then actually the gearing towards equity, which is much more the traditional way of looking at investment trusts, that gearing to equity is currently at 9%. And again, important to remember that's 9% against a low beta portfolio of income generating companies.
Can you explain how you identify stocks suitable for this portfolio?
Yeah, I think there's a couple of steps to the process really. I think first and foremost is understanding the actual business that you're going to invest in. Working out what a company does, how it generates its profits, how it's going to grow those profits in the future, what are the competitive threats, and how the company is positioned within the market. Once you understand the fundamentals, then we need to look at what the company can pay in terms of a dividend, and that's really analysing what the balance sheet strength is like and what the cash flow profile is like. Looking at dividend yield in isolation can be a misleading guide to value, because it's more important to think about how that dividend grows and how it can be maintained going forward, really.
The UK economy appears to be thriving, but there are headwinds out there. What are your expectations for the market and the portfolio?
I think you're right there. I mean, shorter term there are issues. I mean, we have got a UK general election coming up, which could provide volatility in the shorter term. I think medium to longer term, I think the UK equities are reasonably positioned, really. Valuations relative to any other asset classes are good. They look attractive. The underlying economy is strong. The consumer outlook is good with the lower oil price, lower commodity prices, lower food prices, and I think interest rates are going to remain at historical low levels for a protracted period. So in that environment, I think the equity market looks good value. In terms of the trust, I think there will be an ongoing theme of equity income, really. You look at bond yields, it's hard for investors to find that income outside of equity. So I think the trust in that environment does well.
David Smith, thank you very much.
Thank you.